The latest data from the U.S. Department of Labor reveals that the country's non-farm payroll employment increased by 236,000 in March, the smallest gain since December 2020, and slightly below expectations of 239,000. The unemployment rate for March was 3.5%, lower than the expected and prior reading of 3.6% and the lowest since January this year. Employment growth was mainly concentrated in the food services and drinking places sector. However, wage growth was lower than expected, with the average hourly earnings rising at an annual rate of 4.2%, compared to the expected 4.3% and the prior 4.6%. The report shows that employment growth has slowed down, while wages have risen and the unemployment rate has fallen. This presents a complex signal to the Federal Reserve, which is still considering whether to raise interest rates. On one hand, the U.S. job market remains strong, and this figure may open the door to further interest rate hikes, especially if next week's CPI data unexpectedly rises again. On the other hand, labor force participation is increasing, average working hours are decreasing, and average hourly earnings show that wage inflation is easing. This is encouraging news for the Fed, as it indicates that labor demand may be softening, which could reduce the pressure on them to further raise interest rates. The non-farm payroll report reflects hiring trends in early March, and the impact of bank failures may not yet be fully visible. As credit conditions tighten, small businesses and consumers may find it harder to obtain loans, which could ultimately lead to more layoffs. Large corporations are also proactively cutting jobs, with Goldman Sachs announcing plans to cut 3,200 jobs, Disney starting layoffs at the end of March, and Zoom cutting 15% of its workforce. In March this year, U.S. employers announced a total of 89,703 job cuts, up 15% from February and an increase of 319% from the same period last year. According to a UBS report, small businesses in the U.S. are experiencing a wave of bankruptcies, with the number of bankrupt firms surpassing the period of economic shutdown caused by the pandemic. The industries hit hardest in this wave of bankruptcies include real estate, healthcare, chemicals, and retail. In addition to interest rate hikes and tightening credit conditions, President Biden's plan to raise the corporate income tax to 28% in the coming months could further worsen the situation for businesses. For the market, this is a relatively good employment report, which could be seen as one good cover-up for 100 ugliness. After the data was released, short-term futures for the three major U.S. stock indices turned positive, as did the U.S. dollar index, the yield on 10-year U.S. Treasury bonds, and the yield on 30-year U.S. Treasury bonds. The probability of a rate hike by the Federal Reserve in May has exceeded 2/3. However, as the UBS report points out, the sharp rise in job cuts and bankruptcies in small businesses is a warning signal that cannot be ignored. The market and the Fed need to keep a close eye on the underlying weaknesses in the U.S. economy, such as the still high levels of long-term unemployed, the unevenness of the recovery, and the impact of potential tax increases and tightening credit conditions.